There are some people that think you have to own everything, that you should own an index and own like a global world index and make sure that you own everything. And this gets a little bit into the math nerdy background, but you don't need everything. All the benefit of diversification comes if you have things that are uncorrelated, things that move in opposite directions. That one will go up when the other goes down. That doesn't mean you have to own everything. If you can find 10 things that are different, I mean really different, that, when the stock market is down, one of them is up, or when one is up, the other is down. If you can find 10 things that are truly different, you're much more diversified than somebody who owns an index with 500 companies, but 450 of them move the same way every day. You don't need to own everything, and you also don't need to own things you don't understand. You can get fantastic returns just owning things that are in your comfort zone.
Welcome to Investing Insights, where we chat with experts from various industries to uncover investing and life lessons that empower everyday people like you. Today, we're going deep into the mechanics of the economy and the physical world with Stephen Farrington. Stephen is the creator of the Value Degen Substack, where he shares unfiltered, high-conviction takes on small-cap value stocks. Formerly a financial advisor at Merrill Lynch and a finance professor, he now lives in the trenches of deep fundamental research, hunting for asymmetric opportunities in overlooked sectors like materials and commodities. He's here to help us understand how markets actually work and how to spot value where others see only risk. This podcast episode is for financial education purposes only and does not constitute financial advice. Always consult a qualified professional for personalized guidance. Stephen, thanks for joining us at Investing Insights.
Thank you for having me. It's a huge pleasure to be here.
You've moved from a job of being a financial advisor at Merrill Lynch to the very raw energy, maybe even sometimes lonely work of doing value investing from home for yourself. And I think you got famous on Substack and for your research because you're focusing on anything physical. And I would like to understand, why are we moving from stock market focused on software business, now moving into hard assets and physical businesses?
Well, certainly right now, I'm focusing on a lot of physical businesses because of the current AI disruption. We've just had maybe 15 years where the sexiest businesses were capital light and they were infinitely scalable at very little cost. Once you write a piece of software, the marginal cost, the cost of your company for one more user to sign up is zero, right? So if you've paid for all of this software programming and you get one more customer, that one more customer is 100% profit because you don't have to add any costs associated to it. Those business mechanics are so powerful that all other businesses were so much less sexy by comparison that it kind of sucked all the oxygen out of the room. And all anybody cared about were these capital-light businesses that were infinitely scalable. They got all the attention, they got all the fund flows. But we're living in this moment of artificial intelligence, and it really started just last November, and then it really got dialed up to 11, I think January 2nd. Anthropic released their Opus 4.5 Claude code, and apparently it's so good at writing software, so I've heard, because I'm not very good at software. But the narrative is that it's so good at writing software, within a few short years, there won't be very many human beings employed in writing software, and there will have been so much software written that the amount people will be able to charge that user to use that software platform is going to collapse. So software is going to become very abundant, very cheap, and maybe with a lot fewer people working in that industry. Those are some of the predictions, and I think those are viable predictions. Most industrial revolutions in the past, like if you look at the famous example is weaving looms, and then there were these famous Luddites. Their leader was somebody named, he called himself General Ludd, and they were smashing the looms to make sure people didn't lose their jobs. If you follow England for the next 50 or 60 years, with the addition of looms, the amount of employment in that industry only increased. You look forward to 50, 60, 100 years, the number of people in England working in the weaving and textiles business, had grown to many multiples, and they were employing a lot more people. AI, the fear is that it's so revolutionary, it's so transformative, that this is an industrial revolution where the opposite happens, where it really does, that industry employs a lot fewer people, that the number of software engineers will be a lot fewer. Well, we'll have to see how it plays out. And honestly, nobody knows. But in the meantime, everybody's in a rush to buy things that AI can't disrupt. whether that's, a chemicals plant or a real estate company or a copper mine, those sectors which have been, unloved and not cared about for 20 years are now getting a lot of attention.
So how do you do that? So I understand it. I started to invest in some semiconductor stocks, and then you think about, okay, a data center. The data center needs a server, and inside the server there's a copper cable. But then there's a trucking or construction company like building that data center, and then those workers, they need some housing. How do you approach that when you analyze an industry and then you focus on all those small caps and side businesses that will boom or make money from it? Do you visit such a data center construction site? Do you call out those companies, or you just do a deep dive research on so many related industries?
Occasionally I will do, a channel check. Not frequently, but I have done a channel check, especially if I'm writing about a restaurant and there's a branch nearby. I'll go and try the food. I haven't driven out to Texas to the Permian Basin to look at the data centers, but it all comes down. Every researcher has their own circle of competence, the things that they're good at, the things that they're not. And with the data center build out, I was not good enough at tech to recognize that GPU was going to be the bottleneck. And I did not miss when the bottleneck switched from GPUs to memory. And then, attention shifted from NVIDIA to Micron. And the Micron tripled in value. And I think some attention is going back to NVIDIA again. Those aspects were outside of my competence. But I was able to figure out within my circle of competence, my best performing stock of 2025. Part of the narrative was, we're going to build this stuff so fast. We need more data centers faster than we can produce the electricity to power them. So I knew that power was going to be a bottleneck. And as I look at electricity, which is maybe a little bit more simple for someone like me to understand who's more low tech, what was amazing is GE Vernova, the spinoff from General Electric that makes the natural gas power plant turbines, they perceived the data center build out as a sort of a temporary flash in the pan. And they said, we're not going to expand capacity just because the circus has come to town, because this is going to come, it's going to go, and it's not reliable. Now, that probably was a mistake for GE Vernova to do. This demand for data center electricity probably will, have a 10-year lifespan to support an expansion of their capacity, but they didn't do it. So if GE Vernova says it's a 5-year wait for new natural gas turbines and a new nuclear plant, even if the regulators were easy to work with, it would be 5 years. Where could we get electricity in a hurry? And my belief was that in the United States, most of the world is still increasing the amount of coal they use, but in the United States, coal has been replaced by natural gas consumption. But there are still shuttered coal plants all over the country. And I thought that we would get some coal restarts or maybe some coal to natural gas conversions. And there was a 160-year-old company. It's called Babcock and Wilcox, and they're the market leader in steam turbines. And they would be a benefit. The engineering services they provide would be a benefit for coal restarts and coal conversions. And to my absolute shock, they got new build orders. These data centers want electricity so badly that they're willing, in the year of our Lord 2020, to build a brand new natural gas steam turbine electric plant, which is absolutely shocking. But that's the consequence if GE Vernova says you have to wait 5 years. So this little company, the symbol is BW, Babcock and Wilcox, the market leader in steam turbines. I wasn't smart enough in tech to recognize the GPU bottleneck or the memory bottleneck, but I knew that electricity was in short supply. I made enough to make a difference. Sometimes you have a good idea and you don't buy enough to make a difference, but I bought enough to make a difference, and Babcock and Wilcox has done amazing getting new build orders to make. It is kind of amazing that we're so far advanced in technology, but we're still going to build brand new steam turbine power plants.
Interesting. So you recognize you cannot be an expert on all industries, so you don't need a diversification just everywhere just to have your foot in each door. You just focus on what you can control, which is your research. How do you structure your portfolio then? Do you just go for those small specific companies, or do you also hold some index funds? Do you buy into some bigger corporations because of their dividends or such?
So myself personally, I only do small companies. And you asked about diversification. There are some people that think you have to own everything, that you should own an index and own like a global world index and make sure that you own everything. And this gets a little bit into the math nerdy background, but you don't need everything. all the benefit of diversification comes if you have things that are uncorrelated, things that move in opposite directions. That one will go up when the other goes down. That doesn't mean you have to own everything. If you can find 10 things that are different, I mean really different, that when the stock market is down, one of them is up, or when one is up, the other is down. If you can find 10 things that are truly different, you're much more diversified than somebody who owns an index with 500 companies, but 450 of them move the same way every day. You don't need to own everything, and you also don't need to own things you don't understand. You can get fantastic returns just owning things that are in your comfort zone. Sometimes, if I have a macro view of the world that I really want to invest in, sometimes I can't find a small company with exposure to it. Sometimes I have to go up to a mid cap. I really don't play around in large caps because even if you get the theme right, it can't really do that much for the company, not unless you really get the timing good. I focus on small companies, and yeah, there's enough out there that should be unrelated, that I think it's just a fantastic time. I really enjoy it.
So how long is your holding period, and how often do you shuffle your portfolio?
Well, so my holding period, it is smart to take profits. There are a lot of positions that I've cut in half recently. So, for example, one of the themes that I wrote about in 2024 was that there was a narrative that electric vehicles were going to take over the world. Maybe by 2035, we'll all be driving electric vehicles. And I just assumed that was correct because it was the narrative and that's what everybody thought. But as I was doing research into mining, one of the most famous mining CEOs said, this is not possible. There is not enough nickel. If you gave me money with a zero, if you gave me an infinite loan, I couldn't give you enough nickel to make all these electric vehicles. There is no way. There is zero chance we're all going to be driving electric vehicles by 2035. Nickel doesn't exist. And I saw, it was kind of amazing. The CEO of Toyota did not embrace electric vehicles. He correctly identified the metal shortage and said that the market is going to want hybrids for this bridging period. And so Toyota made the most sophisticated hybrids. The narrative didn't shift in time for him. The board still fired him, right? The CEO of Toyota was right and he was still fired. But now that the narrative is caught up, it turns out he was absolutely correct. Internal combustion engines have a catalytic converter that's filled with platinum group metals, platinum, palladium, and rhodium, to capture some of that exhaust so that you don't have everybody dying from particulates and smog in these cities. Hybrid vehicles, the electric vehicles don't use any of that because they don't have any emissions. But hybrid vehicles, the catalytic converters use 15% more platinum group metals. So the dominant narrative was that we weren't really going to need much in the way of platinum mining. And the reality was we were going to need more than ever. So I was buying a platinum miner in South Africa, and the stock price has gone from $3.50 to $20. Now, the story isn't over, but the story, you're getting to the last half of the book now. The trip from $3.50 to $20 is done. It might go from $20 to $40. I don't think it's going to go from $20 to $200. So in that sort of situation, I sell half of the position. It's called taking profits, and it's very healthy. And kind of psychologically, the right number is to trim half, because no matter what happens, you still feel like you're the winner, right? If the stock price crashes, you say, hey, I was smart and I got half out of it. And if the stock price keeps going higher, you say, hey, I'm smart. I have the position riding the whole way. So trimming half the position and taking some psychological dopamine and serotonin off the table is one of the healthiest things you can do when a narrative is about half finished. But I try and find things that are going to take 2, 3, 4, 5 years, because a lot of people in the marketplace are looking forward 3 months or 6 months. And if you're looking forward 2 or 3 years, I think you have an advantage over them. But sometimes, in the case of Babcock and Wilcox, that steam boiler company, it reached my price target in under a year, right? It went from $1.50 to $10 in less than 1 year. So when that happens, you have to sit back and rethink, okay, well, what am I doing here? So I have a longer term time horizon in my mind, but sometimes narratives change very quickly.
I mean, it's great to see that you have, maybe it's also because of your background being an economics professor, you have a very rational approach to it. Like, you're not emotionally that much invested in a company and said, that was my pick and now I have to hold on to it forever. It's about the game is about getting the best returns, right? And that, looking at that on a yearly and then over many years, then sequentially always getting your returns that you envision to have, and then finding maybe the next investment. So, as me being an Austrian, I would also like to hear more about your background, that you know about the Austrian economics. In our pre-conversations, you mentioned the term malinvestment, and which also ties into investment life cycles and such. Could you explain that to me and to the audience again? Because I have not heard about the concept before, but I think it's interesting to hear your
Yeah, no,
thoughts on this one.
Austrian economics is incredible. There were three, I mean, truly brilliant people in Austria. And also, the Austrian Empire at that time, it was considered to be, somewhat rural and less developed than Germany. But if you look at the scientific contributions coming out of Vienna compared to a much wealthier and much more cosmopolitan Berlin, it's kind of impressive. So it is worth going back and looking at the culture inside that university and figure out why did it create so many incredible minds. And it has some huge surprises to me. Attendance was not mandatory, right? If you passed the final exam, you got the degree. So the vast majority of students paid a private tutor, never went to class, passed the exams, and got credentialed to do their jobs. Only about 5 or 10% of the students showed up to class, and those were the ones who were going to be future researchers and professors. The university really only existed for the smartest 5%. And also, if you were a student, you could attend every lecture. So the 5% of students that were going to become the future researchers, they attended every class of every discipline, and they all knew each other, and they were all friends, and they all shared ideas and bounced ideas out of each other. Compare that to the university today, where everybody has to attend only their classes, right? You're not allowed to attend classes you're not registered for, and the class is filled with 90% of students that don't want to be there. The amount of research that the University of Vienna created with that system is absolutely incredible. And also, most of the faculty weren't paid. The faculty were people who were successful, highly successful in their own industry, and they taught as an honorific, right? It was an honor to teach. There were very few salaried people at the university. And so you have this problem now in academia where I was at a finance conference recently, and one of the questions from the audience is, if you're right about this, why aren't you rich? Or, are you a millionaire? If you're doing finance research, are you actually practicing any of this stuff? And and there's a huge disconnect between academia and the business worlds. The University of Vienna didn't have that. The researchers were learning from people who were successful in their industry, who had experience and judgment. The classes were only filled with the brightest people that wanted to be there. So anyway, Austrian economics, there were three brilliant minds: Karl Menger, and then the next generation was Eugen von Bauwerk. And I think he was on, before the euro, he was on your 10 shilling note. He's a very, very bald guy. And then the third generation has Ludwig von Mises and Friedrich Hayek, who got the Nobel Prize in the 1970s. And what Mises and Hayek specifically built off of the foundation that they inherited was this idea that when interest rates are pushed below the rate that the market would clear, because you have this demand for money, you've got a supply of money, and you have price controls from the central bank. And when the central bank has their thumb on the scale and they push interest rates too low, people do very silly things, right? You might have a city that could handle 5 new apartment buildings. But what if they build 15? Well, they built 15 because interest rates should have been 5%, but they were 2%, and you could borrow money more cheaply. And it made the future resale of those apartments seem more expensive, because then the customers, they could take a mortgage more cheaply. So it really threw off everybody's calculations. And you have these long-term plans. Maybe there's not enough skilled labor. Maybe there's not enough concrete and steel to build 15 apartment buildings. And you start seeing a huge cost push inflation from these building material side of things. And before a financial crash, you often see inflation spike in the inputs of heavy industry, in the steel and the concrete and the skilled labor, right? And what, the concept of a malinvestment, or some people, they don't like the term malinvestment, they use excess capacity. These things are still good. Apartment buildings are good, but you can build too many of them. And that can be caused by interest rates being too low. Now, there's a little bit of back and forth. Interest rates being too low are usually an important part of it. But sometimes people just get together and they go absolutely crazy. And we had an example in the United States in the 90s around these stuffed animals called Beanie Babies. And there was a period where people were spending huge sums of money on Beanie Babies. There's a famous picture you can look up. It's a divorce hearing, and the couple is on the floor of the courtroom, and they're splitting their Beanie Baby collection between them. because they thought that these were investments and that they were not some consumer good for your dog to chew or something like that. And what's interesting about Beanie Babies is there was almost no finance involved, almost none of this was done on borrowed money. Interest rates did not really affect the Beanie Baby bubble. Sometimes a mania can just happen, but it's so much worse when the banks are involved in using borrowed money. And it's so much worse when you're actually doing things that are capital intensive and these projects take several years to bring about. And then the crash, on top of that, the Austrians spent a lot of time looking at the fractional reserve banking system and the extra fragility that goes on with the fractional reserve banking system. When a loan goes bad, the money supply contracts. And it doesn't have to be that way, but if you have a sudden shrinking of the money supply, well, that affects people's ability to borrow money for their short-term lendings. We have a lot of financial crises, like the savings and loan crisis in the 1980s. A company's working capital accounts got frozen. They couldn't borrow in the short term to meet their payment obligations. And when the banking system freezes up and the economy grinds to a halt, and that's because you have bad debt in a fractional reserve system. And we don't even have to have a fractional reserve system. We could have a 100% reserve banking system where every mortgage is one-to-one backed by somebody else's time deposit. Right? You have to put money in a bank CD locked up for several years, and then the bank will use that to make a mortgage. There's no reason why we have to have this system still be fractional after all these years, but it's still there. It makes the malinvestment so much more fragile. There's a lot of people looking around that, if the Austrians are so smart, if the Austrians are right, we just had 15 years of interest rates at zero. Where's the malinvestment? And we had it. We had it in Silicon Valley venture capital. We had it in software as a service. The interest rates were so low that all this money poured in to small tech companies. But what was so amazing about it is Silicon Valley is almost entirely equity funded. There was no debt. And the United States has some of the best bankruptcy courts in the world. We can manage malinvestment, as long as there's no debt that causes the fractional reserve banking system to grind to a halt. Malinvestment can be handled by a smoothly functioning capital market. And so there's a lot of people who are still waiting for the other shoe to drop. They're still waiting for this huge recession. When will the market crash after 15 years of interest rates at zero? And, I think we've had it. We had malinvestment. We had malinvestment in software. And it was this very unique situation where there was no debt in the banking system, and the malinvestment is in the process of being digested and being absorbed. And now we are in a world where, the interest rates are falling, and we're ready to overinvest in the next thing. And I think everybody with eyes and ears can see that it's probably going to be data centers. That if you look forward, whether it's 3, 4, 5 years from now, we'll find out we built too many data centers. And maybe that will be made worse by having a Federal Reserve Bank and a president who really wants interest rates lower, lower, lower. We've got a new Fed chair. They're going to bring interest rates as low as they can go. But I think we're just at the beginning of the new cycle, which means I think we have years and years ahead of us of an open field and an open runway. But yeah, that's my take on the current marketplace based on Friedrich Hayek and Ludwig von Mises and a bunch of brilliant people from Austria who, they don't get the credit they deserve, maybe.
Thank you. Great historical look back. So yeah, and that was actually my question. What if we combine this now? We hear already there's an AI bubble and we are overbuilding, especially in the US. And then on top of that, you give out cheap money or easy money because we see already a lot of the CapEx spend is done with debt now and loans and credits. Now you make that even cheaper, then you can just accelerators raise even more.
Yeah, the potential for there to be a really painful bubble if interest rates are low, it really is there. Because, for example, some capital you deploy, some things can be repurposed. If you build too much of something, for example, a great example of this is I think it's General Motors. When General Motors built their corporate headquarters, I think they must have been worried about bankruptcy. Check out the headquarters of General Motors. They built an office tower that could easily be converted into a shopping mall. So they said, okay, just in case we go bankrupt, this building that we're building is going to have some residual value and a second purpose. I think it's just an amazing looking building to see it kind of an office tower shopping mall. So, the office tower is there, but if worse comes to worse, it could be a mall. Come to find out, malls are kind of not so popular in the United States with online commerce now anyway. Some things that are deployed, you can repurpose them. If you build too much of something, does it have a secondary use? And for example, we're finding out the amount of office space. This isn't a malinvestment, but the telephone is kind of coming to the end of its lifespan. The young generation doesn't like to talk on the telephone. And because of that, we used to have offices with those cubicle dividers. They're sound barriers. Everybody can be talking on the telephone at the same time. But if nobody's talking on the phone, the amount of square feet per employee has been cut in half. Right? They'll have some little video chat closets. People can go and lock themselves in a little box and do a video chat. But people are working much closer together and without sound dividers between them. So if the amount of square footage per worker is half, we have all these old office buildings, these 50-year-old office buildings that aren't needed. And what's interesting about that is they're not really useful for anything else. To convert them into an apartment building is incredibly expensive. Sometimes the height from the floor to the ceiling is wrong, and the types of windows is wrong. Residences like windows that can be opened in case you're cooking something oily or spicy and you want to let out the air in your apartment. And all of the plumbing and the electricity, they just put the bathrooms next to the elevator. All the plumbing and electricity is in a tiny column for the whole building. For a residential building, you have to have the plumbing go throughout the whole floor, and there's not enough room from the floor to the ceiling to do that. So we're in this world where it just can't be converted easily. There's very few office buildings that make good residential buildings. And also the shape of the building. You want to have more windows. If your office building was a perfect square, well, who wants the apartment in the middle that has no windows? Nobody wants that. So the residential buildings are more of a longer rectangle. What we're building right now with these data centers, if we overbuild data centers, what the heck is this building good for if it's not full of computer servers and racks and things like that? This seems to be that we're going to be building things that have very little purpose, especially, you build something out in the middle of nowhere that it's not on a railroad line for cargo. It's not on a highway. It needs electricity. It needs water, and it needs fiber optic cable. If it's not going to be crunching data, it probably is going to be pretty useless. So if we do overbuild data centers, the inability to reuse those assets for anything else would be pretty devastating. So it has the potential to be a big bubble. I don't think we're anywhere near close to that yet, because we're very early on in the stage of, especially because if you overbuild a consumer good, it's very easy for the demand to fall off if people have a disruption in incomes. But when you're building something that is adding value on the productive side, I think things can go on a little bit longer, which is another reason why historically a lot of bubbles were concentrated in heavy industry. You have things that, like a shipyard. It's hard to repurpose a shipyard. If the shipyard isn't building new ships, what is it going to do? But the data centers currently are adding value and they're making people more productive. And so I think we're still very early on in this whole process. It's only been 3 years since ChatGPT was launched. And if you go back and you look at the internet, 3 years after the Netscape IPO, only 5% of the entire country in the United States was connected to the internet by broadband. Percent were connected by dial-up, and 45% didn't have internet connection at all. And those numbers are for when the dot-com bubble burst in 2000. So that would be 5 years after Netscape's IPO. We're only 3 years after ChatGPT's launch, and the penetration is much faster. I think 75% of white-collar workers are using artificial intelligence every week, and that's going to be rapidly escalating to every day. So the penetration is faster. It's adding productivity. For all the people that are talking about a bubble in artificial intelligence and in data center buildouts, I think it's still surprisingly early. Another way to tell how early it is so the companies that are building these data centers, technology has typically been equity funded. They don't have very much debt. So as they become capital intensive industries, how much debt could Google have before you say, okay, well, they have enough debt? Google, with their market cap, $3 or $4 trillion, Google could take $1 trillion of debt and their balance sheet would still be relatively healthy. And the same is true with Microsoft, and the same is true with Meta. So if you take all of the large tech companies together, it probably won't be over indebted as a group until we're about $4 or $5 trillion in debt on this data center build out. And the question is, in the process of this build out, at what point do we discover that we have enough compute and we're done and we're good? And another thing is, it's such a unique cycle. If you go back and you look at the railroads, it's pretty low tech, and it doesn't take a lot of time to bring online, a new smelter to make steel, compared to these large number of very high tech components that it takes to make a data center. everything from connecting it to fiber optic cable to the transceivers that connect it to the racks to the processors to the CPUs and the GPUs. If Micron says that it's going to take them 5 years or 4 years to expand production for memory, then the speed of the data center build out is sort of slowed down by just how complicated it is. You just can't. It's going to be. It's kind of like if you. I knew a doctor who, when he wanted to put people on a diet, he would give them a tiny spoon, like the kind you would get an ice cream free sample of when you're doing a tasting. And he said, you can eat whatever you want, but you have to eat it with this spoon. And it slowed down people's eating habits so much that they recognized that they were full earlier in the process. And if the AI build out is slowed down by the fact that Taiwan Semiconductor can't expand capacity that fast, and Micron can't expand capacity that fast, it's like we're eating at this buffet with a very small spoon. We might recognize that we're full before we've overeaten. So I'm not fatalistic in that it's all going to be bad and we're going to overbuild and everything's terrible, because there are so many bottlenecks that this build out is going to take years and years and years, and it doesn't have to be all doom and gloom about what's happening. So anyway, this is probably a long-winded thing, but I don't take the negative view of the over build out.
I mean, in such bubble, usually the small ones fall first. It wouldn't be a Microsoft or Google. It would be some supplier like CoreWeave or Nebius that help to build those data centers, then lose some of their deals because they cannot build it. And then on top of that, what I would like to mention as well is the question is, how much value do those data centers create? I mean, the first thing we will see is, yes, they create some more efficiencies within the companies, but then the next thing they will do is take away a lot of jobs. The next question is, what kind of new businesses or business models will they really create? And will those models actually create more value than what was there before? Because you have to substitute all this consumer purchase from all those people first having had a pay slip, and now they don't have anymore. So that's actually on the long term where the problem can come.
Well, hopefully Jean Baptiste Say was correct. Have you ever heard of Say's law? Supply is demand.
No.
Jean Baptiste Say is an old French classical economist. If you go back to the debate between supply side economists or demand side economists, the idea is supply is demand. Productivity is what pays for all of this. So if these data centers are productive, if they're adding value, if they're adding productivity, it might be the case that a lot of people will lose their jobs, but they'll be able to find other jobs because the society is productive. GDP is going to be a supply side phenomenon. And just to put some color on this, I saw a job advertisement the other day. It was for a fitness club DJ, that your gym, your health club, is going to have live music, and they're going to pay somebody $60,000 a year to be a live DJ at a fitness club. Now, that job is only possible because of incredible productivity, and people have lost their jobs to automation. I have from grad school, an acquaintance of mine. He has a PhD in physics, and currently he's walking dogs in St. Petersburg, Florida. And he can make $150 an hour walking people's dogs for them. He's walking several dogs at a time. And he has a PhD in physics. So the PhD in physics was probably misallocated human capital. But the idea that you could have professional dog groomers and professional dog walkers and things like that, it's only possible in a world that's created so much wealth with this enormous productivity. So I don't know what jobs people are going to be doing. It's easy to see the jobs that are going to be destroyed. It's very hard to see the jobs that are going to be created. And there's always the arguments that, those new jobs don't have dignity and things like that. If you talk to people who are using these Web 3.0 apps that are now entrepreneurs and in control of their own destiny, an amazing thing has happened with the gig economy. And you look back to some of these very dour forecasts that compare the fall of Rome with the fall of the United States, that one of the big key transitions in the fall of Rome was that the small landholder, the small family farm, was replaced by large corporate farms. And you have this huge underclass that has to be satisfied with bread and circuses. And so then they make that correlation in the United States, that the number of employees versus the number of small business owners. But one thing that's happened is the gig economy has created tens of millions of new entrepreneurs and small business owners, people that in their own mind think of themselves as in command of their own destiny, thinking about what their next enterprise is going to be. So there are some ways in which this disruption is increasing human dignity, even though you might not think of it. It takes something like, a masseuse, right? A physical therapist that in the past would have worked for a large corporation, and they would have been told who they're massaging. Now they have an app and they can choose their clients, and there's a two-way feedback mechanism, and they can choose who not to have their clients. And the app might keep 10%, but how much was your employer keeping when you worked for a large corporation? It was usually something closer to 60%. So there is a large disruption in labor, and I don't think any of us can see what the end result is going to be. There was another famous French economist. He's considered the sharpest wit in economics, and he had this great essay on in order to create jobs, we should pass a law to block out all the windows so that we have to use candles for light. And I'm drawing a blank on his name, but he has an essay called "That Which Is Seen and That Which Is Unseen." And the whole idea is you can see the jobs that are going to get destroyed by AI, but you can't really see the jobs that are going to be created by this enormous productivity. And I'm terrible at these names. I remember John Baptiste say, but Frédéric Bastiat. He's considered to be the sharpest wit in economics, probably the greatest writer in economics. And his essay, That Which Is Seen, That Which Is Unseen, I think it's perfect for this moment because, just for example, a company that I'm following is called Beeline, and they have a chatbot named Bob who will do mortgage underwriting. You can submit all your documents to Bob, and he will walk you through the whole process, and you can get your mortgage approved that way. And he's 6 times as effective as a human being. He will close mortgage underwriting at 6 times the rate of a person. And there's 300,000 people in the United States currently working in mortgage underwriting. And within a few years, they're all going to have to find something else to do because, if you have a choice between that adds about $11,000 to the cost of every house is the labor that goes into human beings in the mortgage underwriting business, and they're all good paying jobs. So you're going to see one thing is that'll bring interest rates down because that $11,000 of cost is added to the interest rate of your mortgage. It doesn't come out in closing costs, it comes out in an interest rate. So interest rates will be able to come down by just that little bit more on your mortgage, but 300,000 people will be out of work. And what are they going to be doing? Some of them will be fitness club DJs, and some of them will be dog grooming, and some of them we don't even really know what jobs they'll have. One of the really interesting things is that the job losses might be concentrated in all these business process outsourcing facilities in India and the Philippines. The places that are hardest hit might be all the places that we've offshored white collar labor to. Because if you make white collar labor, that much more productive, it turns out we don't need 1 million people in the Philippines answering the phones for customer service for people in the United States. That's 1 million jobs in a relatively small nation. It's going to be, this is a wild time. Everything is moving so fast. It's kind of exciting to be a part of it and to be watching it all happen in real time. The world's never seen, I think, a disruption of this magnitude happen this fast.
If you talk macroeconomics, how would a scenario look like if we have mass unemployment and the government has to kind of give basic income to everyone? Elon Musk is saying universal high income. In Europe, some countries tested the basic income. What is your perspective on that? If
this is
something
one of
like
the
that
worst
would
ideas.
happen,
This is so people have no incentive to learn the new skill and to retrain if you just start paying them. And the idea that this is going to be somehow necessary, I think is ridiculous. There are so many industries that never existed, so many gig economy jobs. People really need to be. It's one of those things that these welfare programs, in people's minds, they're sort of envisioned as sort of a net to catch them when they're falling. And because it takes away so much of the reason to retrain and to turn your life around, it ends up being a net that's holding them down, and it's very unfortunate. So it's sad that it's become such a large talking point. But it doesn't surprise me because journalism in the United States has been pro-socialist for 100 years. You can see the even I think back to elementary school. The heroes we were taught about in elementary school were John Dewey and Helen Keller. And it turns out that they were marching for communism in all the communist parades. We have these institutions constantly pushing socialism and not enough voices out there for freedom and for capitalism and for liberalism when the evidence is so clear-cut that that's what leads to human flourishing and human thriving. It's incredibly unfortunate, these narratives about universal income and all that crapshoot that, if we just give more taxes to the government, they'll change the weather. And if we just give more taxes to the government, they'll end poverty. What happens if you give more taxes to the government, they take that money to pay themselves. And that's one thing that we really saw happen it was really telling in the French Revolution. You had, not the one with the guillotines. There's been like 5 French revolutions, but in one of them, they had all these leftover aristocrats who used to receive a salary from the government. And so they overturn this aristocracy and become a democracy. And they say, well, what do we do with all these aristocrats? Are we going to cut off their salaries? And they didn't cut off their salaries. They just gave them a job title. You'll be the minister in charge of monitoring the quality of tea, and you'll be the minister in charge of monitoring the quality of whatever. The ultimate purpose of government is paying salaries to people that are connected. So when you advocate for these giant programs, universal basic income, that just means you want Ursula von der Leyen's friends to earn $300,000 a year and live in Switzerland for the rest of their lives. It's really the ultimate outcome of that. And it's very unfortunate because it's, I don't think you can do an honest read of history any other way than that the purpose of government is to pay salaries to people in government. And it's always been that way.
I mean, we know it in Europe, it's like that as well. Like, you have pretty good social standards in case you're unemployed. And sometimes just going back to work doesn't give you that much more money. So it's actually nicer to just stay unemployed and live from the state. And that's a problem if people are for too long unemployed. It's difficult to get back on it. And unfortunately, so far, that would be maybe the nice outcome. Let's say no one needs to work anymore, and we would just go out and help others and clean up the beach and study the best books and invent new things. But most of the time, with too much free time, actually, it's not good for our mental health. And we actually start to end up scrolling more on Instagram, consuming more, buying more things we don't need, and not really making the world a better place. That usually happens in the workplace when we work on a new solution that fixes a problem.
I had a good friend from Denmark, and he told me that, if you can pass the exams, if you can get admitted to graduate school, the idea in graduate school is that life begins at 30. You spend as long in college as they'll pay for, and then life begins when you're 30 years old. And in the United States, you have famous stories of the entrepreneurs leaving college to start their businesses, whether it's, Facebook or Microsoft, that again, these social safety nets that seem to be underneath you or lifting you from falling, they end up being a net above you that prevent you from reaching your potential. Where in Denmark, you have people staying in college until they're 30 years old. In the United States, you have people leaving college to found companies. And it's a huge structural shift, but obviously the government paying for all this stuff changes it. So yeah, it's quite a tragedy because I don't think real human flourishing comes with all those guarantees. Real human flourishing has, the hero's story has some amount of struggle. And if you take struggle away from people, I don't know if their lives are as fulfilled.
Let's go back into some investment and stock trading strategies. In our pre-conversation, you've mentioned options are a nuclear weapon. Why shouldn't we give options to beginner investors?
Yeah, when I was a financial advisor, it was a 3-year wait. You had to have 3 years of experience before you were qualified to have access to options. And now it comes activated on the account by default. And they're very devastating. For one thing, most options expire worthless. So if you buy them, you're buying lottery tickets. Lottery tickets are fun. We would always put a lottery ticket in my grandmother's Christmas stocking because, gambling is fun. For a moment, you dream of what it would be like to be rich, but it lasts a moment and then you find out that you're not rich and then you go back to your daily life. So a tiny bit of gambling is fun. But for that to be plan A, for most people to be out there buying options, I think it would be like saying, well, most people should go out there and they should play the lottery as a retirement strategy. And it's not really good or healthy for them. And the same is true. We have this huge rise in online gambling. And for most of Western history, it was seen as a public vice. Gambling was, to be frowned upon. And now it's everywhere. And I've even seen advertisements targeting young people. So I have to imagine there's going to be some sort of legal or regulatory backlash against this as we find out how many young people have been hurting themselves with it. And options are a part of that. When you buy options, they're lottery tickets. When you sell options, you can lose more than you initially wagered. And that's very devastating. Now, see people accounts go to zero, and it is unfortunate. So there's an enormous amount of leverage in options, and it's like any vice, right? If you look at alcohol, alcohol, if you're the master of it, it can make your life better, right? You can be sitting down with your romantic partner at the end of a day, having a nice dinner and 2 glasses of wine. But if you're the slave of alcohol, it can destroy your life entirely. And every one of these mature subjects, whether it's tobacco or alcohol or gambling, they all have the same way. They can, if you're the master of it, you can add a little bit of charm and flavor to your life. And if it's the master of you, it can absolutely destroy you. And it's kind of surprising options are so prevalent and they're everywhere.
Hi, my name is Georg, and I'm the host of Investing Insights. I would love if you could click below and subscribe, because it will help to make our podcast grow and invite even more interesting people to our show. So thanks for your support and enjoy the rest of the show. Yeah, I actually took a course where in 3 months they taught you all the basics of what is a stock to how to build a portfolio, but they kept this whole part about, they talked a bit about value investing and just went straight into options. Say, build your portfolio by just selling puts and calls, and then you build your position. So I started doing that a bit. And then, of course, there's a lot of bets you're taking that don't work out in the way you want. But then you bought a stock or sold a put or a call where the price is 150, but then it's 100 units, and then you have to come up with 15,000 euro or dollar to just, get this into your portfolio, and then you have this huge position where you say, I actually didn't want that much of it, and I just made 200 euro of that bet to now have, I don't know, 15,000 of Amazon in my portfolio. And it just got interesting to me again, because when I started to look at the companies you are covering, actually options and call trading works as well. And there are some good spreads and there's actually good commissions on it. But if you get, the position booked in your portfolio, you don't have to come up with 15,000 because the stock was just $7. So in the end, it's much easier to cover that when you just have come up with $700 or $1,000 instead of the 10 or 15,000.
Yeah, just as a consequence of focusing on small cap stocks, they tend to have a smaller share price. So 100 shares of something that's $5 is easier than 100 shares of something that's $150. And that's just the ancient historical convention that large companies would try and keep their share price, somewhere between $50 and $100, and small companies would keep their share price between $5 and $10. And then options are for a round lot for 100 shares. Some of those conventions are going away. Some companies don't try to keep their share price, around $100 because there's an old blonde joke about a blonde walks into a pizza parlor and she orders a small cheese pizza and she's asked, do you want it cut into 6 slices or to 8? She says, well, I don't think I can eat 8 slices, only cut it into 6. That's anyway, it's those jokes are everywhere. When I was in Hawaii, that was the same joke about Micronesians. And when I was, if you're in Chicago, it's about Polish. Anyway, it's just whatever minority you want to make fun of. But the idea here is that a company can be cut into as many slices as you want. The number of shares doesn't matter. And their choice to try and slice it into as many pieces to keep a certain share price is kind of an ancient historical convention. But a lot of companies have moved away from that. And you get to a $300 share price or a $2,000 share price. And the options market starts falling apart because who can handle 100 shares of something at $2,000 a share? You run out of people pretty quick who can do that. But small caps, you can play with options, and it's a $500 bet to do 100 shares of a $5 stock. So it's a little bit more manageable. At one point on my Substack, I wrote about it a little bit, and I got away from that because it's not for everyone. It's not for a general audience, and I didn't want to have an options-oriented Substack. It would be it's just not right for everybody.
Yeah, I saw recently, of course, for a brokerage, it's quite interesting to have that. I saw a recent, the revenue split of Robinhood, which is famous for attracting retail investors, so individuals. So they did a lot of money with crypto trading. Then they have the prediction markets, and actually now they make a lot of money with options trading. So that's what you've mentioned. You open the account and you can immediately start to trade options, which is very, very dangerous if you don't understand how to do it. And I still don't understand it. Studying it for a year now. So complex topic.
Yeah, I mean, there are ways that you can do options. For example, if you have a position and it's reached, you're ready to exit. You've held it for a couple of years. It's reached your price target and you want to exit. You can exit by selling a call, right? You've sold to somebody else. Somebody else has the right to buy that option, to buy those 100 shares of stock from you. Okay. And so you've now given them control over whether or not they're going to buy it, and they've paid you a little bit of money for that. So when you finally do sell the shares, you might end up with even more than you thought you're going to end up because you got paid for the option and you also sold the shares you wanted to sell. If it's an action you were going to take anyway, say, okay, this position reached its maturity, I want to sell these shares, I'll let somebody pay me for them to be in control of when I sell these shares. Or there's a stock I really want to buy, so I'll sell a put, and somebody else can choose the timing of when I buy this stock, and I'll get paid a little bit of money for that. Fundamentally have made the decision of what you're going to buy and sell. You can use options to make a little bit of money on the side for that. But you're dealing with something that's so powerful. It's kind of like saying, well, do I really want to go experimenting with alcohol? Do I really want to go experimenting with tobacco? Or should I just say, I don't really need to turn this into a hobby. I don't need to become that involved. I think it's maybe a little bit too powerful and too dangerous.
Another thing I've learned with you is the topic about dividend stocks. So I'm young, 34, and the general understanding is you don't need dividend stocks if you're young. Just invest in high growth stocks, and later you can settle for dividend stocks when you turn older. But you've mentioned there's something very powerful and interesting if you use dividends in a smart way. If you use this type of addictive and dopamine-driven tools to actually benefit our portfolio. Please explain.
Yeah, so the traditional thing that the way most people have a relationship with their investments is, they in the US, you have a job, you have a 401k account, the employer contributes some amount to your 401k account. It's behind a penalty box. You can't touch that money till retirement. You get an extra tax penalty. And it's out of sight, out of mind. Most people never think about it for their entire lives. It was when I was a financial advisor, you'd run into people, they're 65 years old. They say, okay, I just retired. This is what my 401k is. Now, what do we do with it? And it's kind of like, you open a prize box and you see what has happened for the last 40 years without you paying attention to it, which is it's kind of a surprise. You spent 40 years never thinking about how you're going to fund yourself in retirement. But it's really this out of sight, out of mind mentality. And the purpose for that is so that people don't access the money early and they don't touch it and they don't hurt their retirement that way, but they become very alienated from their investments. They're not participating in the capital markets. And when you're young, you start out and your first investments are dividend paying stocks, buy $100 worth of a dividend paying stock and make sure that the dividends are swept immediately into your checking account, that it's going to your debit card. And make sure that you have some sort of alert system turned on that when you get a direct deposit, it's going to ping your phone and it's going to buzz you and you're going to get a text saying, this dividend of $5 has just been swept into your checking account. The first time you see that, you're going to like, oh, that's kind of funny. I put $100 in a stock and I had $5 swept into my checking account. But over time, maybe you're just putting $100 a month, you're buying a different dividend paying stock. And if you get in this habit, by the time a couple of years have gone by, it's like having an old friend that's happy to see you at the end of the day, right? You come home and you see a golden retriever and they're smiling and they're happy to see you. You keep getting all these buzzes in your pocket. It's $5 here, it's $20 there. And then I would encourage you also to spend the money, right? You get a dividend and it's $20. Well, go out somewhere nice for lunch. Make sure you treat yourself and you enjoy it. And what's going to happen is it's going to build up this pathway in your brain that it's a pathway to pleasure. Then you're going to connect the concept of taking money, buying a stock, this pathway in your brain with serotonin and dopamine and pleasure. And you're going to feel over time like you're not rowing the boat by yourself, that there's somebody there rowing it with you. And as you do this for a few years, suddenly you start getting dividends that are enough to cover your water bill or your sewer bill or at some point you get a dividend check comes in and it covers your electric bill. And it feels like you're not alone, and you really start to appreciate that your ownership in businesses, your ownership of the capital stock paying you a rent, right? It's working along with you, that you have an income stream that's not just your labor side of the equation, but it's also the capital side of the equation. And then when that happens, you're going to enjoy saving. Saving is not going to be a chore that's something you're supposed to do because your parents told you to do it. You think, oh, this is what good people have to do. You're going to be an active part of it and you're going to enjoy it and you're going to think about it and say, what should I invest in this time? Or I have a lot of dividends hitting in March, but I don't have dividends hitting in February. Let me look for companies that pay a dividend in February. And it becomes something fun. And now you're an active participant in capitalism. And so even though dividend stocks are mostly thought of for old people that need the income, if you don't take that money and put it behind a lockbox and put it into a retirement account where you're not allowed to touch it, but you put it in an account that can sweep dividends into your debit card, into your checking account, you become an active capitalist, you become an active entrepreneur, a business owner, and your whole mentality shifts. I think that's something that would be a huge improvement for a lot of people, because as a financial advisor, there were just so many people that hit age 65. They open up the envelope that they get from their 401k company and they say, hey, well, I guess let's see what our retirement looks like. And it's the first time they've thought about it in their entire lives. And it's kind of shocking that they've never taken, an active interest in their own future. If you look back at the progress for universal suffrage, as we went from having only, there were kings and lords all the way to universal suffrage, there was an in-between period. And the debates from that time were really interesting. One of them was called the leveler movement. There was a time period where anybody who owned property, even a business, even a warehouse, if you owned inventory, if you owned a business, you could vote. but employees were considered to be equal standing as slaves. If you didn't control your own destiny, your opinion shouldn't matter. And, I think there was an element of truth to that. If you are thinking about the future, if you control your own destiny, it's a very different life than if you just have a blind trust, blind faith in the system that if I just do the employer matching contribution to my 401k, then when I turn 65, I'm going to be okay. I'm going to be taken care of. That's an awful lot of trust to put in a society that has known to have systemic failures here and there. I definitely would encourage people to receive those dividends, enjoy them, and make it something fun. Make it something that becomes habit forming.
Yeah, amazing. Never thought about it in that way, but super powerful. And not even mentioning that some of those stocks might go up as well and increase in value besides the dividends, and you can exit it one
Yeah.
day
Well,
and
there's
do something nice
there's
with
a
that
niche
money.
of people that are into those. They call them dividend growth stocks. The dividend might be small, but the dividend grows every year, and that's a whole different subculture in investing. But then that is its own sort of thrilling reward. To say, hey, I bought this thing 10 years ago, and now my annual dividend is as much as I paid for it. So there's definitely a group of people that like those dividend growth stories.
And another topic is the difficulty of selling or exiting a position, especially when it's down. Let's say I've invested in something, it's down 20, 30%, and I just don't feel like I want to take this loss, even though I could reinvest it in something that actually makes up for the loss. But that's very difficult to calculate, and also emotionally, it's difficult. You've mentioned one example where I think a colleague or a friend just put it in a sub account and forgot about it. But is that the general recommendation? What's your thought about mentally? Like, should we do that? Should we just keep those losers and wait until they go up? Or should we learn how to accept losses?
Well, the big difference is if the facts have changed. So there were a lot of companies coming into the year 2025. A lot of people were expecting an economic recovery. There was a lot of optimism for Trump because he was so good for the economy in his first term. And then came Liberation Day, then came the tariffs, and it was a huge shock, and the economy sort of paralyzed and seized up. And all of these companies that people thought starting in 2025 were going to have a rebound, well, they sold off instead. They instead of having a great year, they had a terrible year. A lot of them were perfectly good companies, and they're on track to have an amazing 2026. So a lot of it depends if the underlying facts have changed. So if you buy a company for a purpose, if you know what you own, you buy a company for a purpose, and sometimes the thesis is wrong. Sometimes some new information comes out, and you say, oh well. Um, for example, a lot of people focus on defense contractors. I'm going to invest in this company because they're going to receive a government contract or a government grant. Well, if they turn around and don't get that contract, maybe it's the time to either the stock price is down, but you should sell. I'll take an example. There's a restaurant chain that I have invested in. It's called Portillo's, and it's a Chicago restaurant chain. It's very small. They only have 100 locations, and their chief marketing officer got poached. Their chief marketing officer got hired away to be the chief executive officer of another restaurant chain. And that executive search takes a long time. They were a whole year without a chief marketing officer. And in the year without a chief marketing officer, their results weren't great. Now you have to go back and say, well, you look at a company with bad results. Is this because it's a bad company? Is this because they have the wrong market fit? Is it because there's no room for this restaurant in the economy? Or is it because they just didn't have a chief marketing officer? So in that case, when the stock price fell, I bought more. They've since gone back. They've hired a new chief marketing officer, and we'll see what 2026 happens. There's another one where there's another company that the price was down and I did sell. And it was because with the AI disruption in software, I had a handful of small tech companies, and some of those I did trim. They fell 30% on this Claude Code Opus 4.5. And I think that narrative that AI is going to devour all software, I think that narrative is going to be around for a year or two. And I think those stocks, the small software stocks, they're going to just keep on falling. And maybe in a year and a half, I'll go back and dig in and revisit them and say, okay, who's still growing revenue? Who's still taking market share? Who's using AI and who's not? But now is not the time for that. So the more I learn about investing, the more I learn that any kind of rule you can come up with, the answer is really, it depends. If something's down, should you sell it? It depends. If something's up, should you sell it? It depends. It's all, where do we go from here and what does the future look like from here? And that's what's so good about it is, the odds that I can get replaced by AI is so small because everything is a judgment and everything is, it depends.
Yeah. And The big learning is whenever you buy a single stock, you have to understand it. Just buying something because it sounds nice or your best friends bought it, it doesn't help you, especially when it's down. You're just lost.
Yeah, and because every stock has ups and downs. And if you don't have the conviction, then when the stock price falls, you don't know what you own, then you're going to get shaken out of it. You're going to sell it because you don't really believe in it and you don't understand it. That's, for example, I have the image behind me. I have my mascot, and he's trying on these ridiculous shoes at the store called Crocs.
Crocs, yes.
Um, Crocs is a company that a lot of people have sold because they believe that the growth story was over. But at the same time, they're growing 30% year over year in China. And there's this whole culture of East Asian women in Japan and Korea and China that love wearing Crocs. So they're having incredible success in their social media marketing and getting influencers to wear their footwear. And the growth story, they just flipped from being a company that's 50% US sales to being 50% international sales. So people sold off the stock thinking that the growth was over, and you scratch the surface and the growth is still there. And it all just comes down to knowing what you bought and why you bought it, which is, if you like research, if you like learning, there's always something new to learn. There's always something happening in the world, and it's just fantastic.
Let's get your insights on a few more industries. Life settlements. You have a interesting stock pick there.
Yeah, this is a really niche one. This is my best idea right now, and I'm pounding the table about it. In the United States, there was a Supreme Court case in 1911 that declared that your life insurance policy is your personal property. And as personal property, you have the right to assign it. You can sell it. Your life insurance policy is something that you own and you can sell. And this is very uncommon in the world. Most countries, this does not exist. Most countries, the contract is between you and the life insurance company, and there can be no third parties involved. What that means is, as you age, as you get close to the finish line, this policy becomes more and more valuable, maybe starting about the time you're 70 years old. And at the same time, most people buy life insurance when they're in their 30s. So you're young, you're married, you have kids. You say, if I die, if I'm in a car accident, can my wife pay off the mortgage and can my kids go to college? So somebody might take out a $1 million life insurance policy. But most people don't die in their 30s. You get to be 70, you get to be 65, and your income falls because you're no longer working. And you have this monthly bill. You say, why am I sending money to the life insurance company every month to get $1 million when I die? My mortgage is paid off and my kids have graduated college. My kids have their own careers. One's a dentist, one's a whatever. The life insurance policy doesn't have a purpose anymore. Without a purpose, 90% of life insurance policies are just abandoned. They just lapse. People get to be 70 years old and they say, you know what, $1,000 a month that I'm paying to a life insurance company so that my estate gets $1 million, that doesn't make any sense. $1,000 a month now, I can take my wife and we can go on Norwegian cruise lines. We can have some fun. So in a world where 90% of life insurance policies lapse because people stop paying the payments, there is a company who will buy that policy from you. They'll buy the policy, they'll make the payments, and then when you pass away, they'll receive the $1 million. So if you're 70 years old and you have $1 million life insurance policy and that monthly bill is burdensome, there's a company, and these are kind of rough figures. It depends on your gender and if you're a smoker and things like that. But if you call up the insurance company, sometimes they'll offer you a redemption value, right? You've got $1 million policy, the life insurance company will offer you $30,000 if you surrender it. Abacus Global Management, the symbol is ABX, is going to offer you somewhere in the neighborhood of $210,000. It's about 7 times what the life insurance policy offers in surrender value. And suddenly you take a $1,000 a month monthly bill and you turn it into a $210,000 check that you can then spend to enjoy your retirement. And it's not always about enjoying retirement, because in the US, the elder care facilities for the nicer quality ones are incredibly expensive. And you have a situation where, I have an aunt who had a stroke recently, and she was in a rehab facility and a senior care facility for several months. And she's not of means; she can't pay for the high end ones. And at the sort of regular everyday elder care facilities, when it's a holiday and 2 or 3 nurses call in sick because they're not actually sick, but because they want to go out partying for St. Patrick's Day or whatever holiday it is, if you're short-staffed in a nursing home, you'll have the 80-year-old people who are ringing the buzzer to have a nurse come and help them, and nobody comes because they don't have the staff on hand. The quality of life at the mass market elder care facilities is really shocking, and it's a sort of a dark part of society that people don't look at very often, and it's a terrifying part of society. If you can afford $7 to $10 to $12,000 a month for the high end posh ones, where they have plenty of staff and they come when you call the buzzer and they have nice meals, the quality of life in your last few years is much higher. So if you have the ability to surrender a life insurance policy that'll pay for 3 years of long term care for your parents, I think a lot of people are going to find a lot of value in that. So, this company, Abacus Global Management, their symbol is ABX. They will buy your life insurance policy. They'll give you that lump sum cash payment now. And then, from the company's point of view, they take that policy and they turn around, they bundle them together, and they sell them to private credit institutions for about a 20% markup. So the risk that Abacus has, they're not keeping these life insurance policies on the books. There is risk in holding these assets. What if we discover a new longevity treatment and everybody starts living 10 years longer? Well, in that case, you wouldn't want to be holding a huge bundle of these life insurance policies. You have to pay the monthly payment for an extra 10 years before the policies finally reach the end of their life cycle. So this company, Abacus Global Management, by being the bundler, by being the originator of these policies and then selling them to private credit, it's a pretty remarkable business. And the market is so underpenetrated. Last year in the US, life insurance is a $13 trillion asset class, which is, I think, bigger than the stock market, the Euronext, right? I think probably more than twice the size of the Euronext. It's a huge asset class in the United States, $13 trillion asset class. Last year, $450 billion of life insurance policies lapsed and were canceled. $150 billion of those policies, people were old enough to have had a sale value. They could have called Abacus and sold them. And the entire industry, Abacus and all their competitors, were only able to buy about $5 billion worth of policies. It was $145 billion of policies that were not sold because the public does not know that this exists. So the marketing that has to be done to raise public awareness and to teach them that life insurance policies have a value and can be sold, this company could grow 30 times and the market would still be underpenetrated. And that's what it is, this enormous runway for growth. They're the market leader in their space, and they could grow 30 times and the market would still be underserved. And we have the baby boomer generation, the baby boomer demographic. They have $75 trillion of assets. The elder care facilities are bursting at the seams. They're very expensive. They need to raise money from somewhere to pay for them. And I think this company, Abacus Global Management, is going to be a huge beneficiary of those tailwinds. That the baby boomer generation, the size of them, the wealth that they have, and the amount of life insurance policies that lapse, this totally underpenetrated, underserved market that nobody knows about. I can't pound the table hard enough. It's in my personal account. It's my largest position. I've spoke with the CEO a couple of times. I actually have a call scheduled with him tomorrow for our third call. I've written about it 6 times on my Substack. It's an incredible opportunity, and you just don't find underserved markets, market leaders in an underserved market with such growth potential. You don't, I turn over a lot of rocks looking for treasure. You don't find things like this all the time. You can look for years and not find something quite so amazing.
How did you find that? Just by talking to someone and then explaining it, or?
So I had focused on this theme of baby boomers and how they're going to manage their last few years. I call it the silver tsunami, or the silver-haired tsunami. That there's this huge demographic, this enormous population pyramid, and we call it a pig and a python, right? That there's this huge lump moving through the population. And how they're going to manage their finances, I found the market leader in variable annuities. It's called Jackson Financial. And that's been since I first found it, it's gone from $40 a share to $112 a share. It's been a fantastic company. And it's still a fantastic company. I think it's going to go to $300 a share over the next 5 years. So Jackson Financial is also amazing. And I found the market leader in reverse mortgages. So a reverse mortgage, and these are not popular in every country too, but you live in your house, you own your house free and clear. A finance company will say, hey, we'll send you an extra, would your retirement be more comfortable if we send you an extra $1,500 a month in the mail? Instead of a normal mortgage where you're paying the bank $1,500 a month, this reverse mortgage company is going to take a 70-year-old. We're going to pay you $1,500 a month, and a mortgage will start accruing against your house. And when you pass away, your estate has a year to sell the house and to pay off this mortgage claim. It's called a reverse mortgage. The market leader in reverse mortgages is called Finance of America Companies. Symbol is FOA. They did an acquisition. They didn't digest it well. They have some speed bumps and some hiccups. Now, it's still gone from $5 to $22 since I wrote about it. It's still been very good, but they didn't digest the acquisition as well as they could have. They have made mistakes. And I found Abacus because they share the same advertising channels. If you're at the gym working out in the United States and there's things playing on the television, you'll get Finance of America Companies and you'll get Abacus Global Management's advertisements kind of back to back on the television. They're advertising to the same people. A lot of the gyms are filled with retired people, and that's on their mind. So that's how I found them, is that these companies were sort of back to back, saying, wait a minute, is this company public? What's going on? Because this is also a service that the senior citizens are going to need. So yeah, that's I have these three companies that I've written about: Jackson Financial, the market leader in variable annuities; Finance of America, the market leader in reverse mortgages. But the one that has managed their acquisitions, has been executing flawlessly, has been making no mistakes, is Abacus Global Management. And it's such an incredible company, and its reverse mortgages are much more established, much less underpenetrated market. Although that still has a lot of room to go, because in the United States, if you take the median 65-year-old, so if you line up all 65-year-olds from end to end, the median, their retirement savings is their primary residence. That's it. So the median American, their plan is to live on Social Security, and that works if it's a husband and wife together that own their own house. 2 Social Security checks can cover the household expenses. But when one of them passes away, that generation, when they got married, the man was a couple years older than the wife on average, and then the wife tends to live about 8 years longer, 6 or 8 years longer. So the average baby boomer woman, she has to plan on being a widow for 10 years. And when you have the household expenses, the insurance, the maintenance on one Social Security check, it really doesn't work anymore. So that 10 years where the average American baby boomer woman is a widow needs some sort of help in raising income. And that's where, for those 10 years, a reverse mortgage is a really good fit. A life settlement, selling a life insurance policy, is a really good fit. Or maybe when the husband passes away, they get the big life insurance payout. Maybe they get the $1 million from the husband's life insurance policy. Then they bring it to Jackson Financial and they buy a variable annuity. So those 3 companies, I think, are going to be pretty critical in helping the baby boomers navigate their last decade or two.
Really good insight. My wife says it a lot. She says there's not enough marketing and products out there, especially for the baby boomers or retired people. There's more coming, and we focus always on getting the youngest ones, but there's actually a lot of potential. So thanks for that insight. Even to get to know you a bit better, let us know, how has past failure set you up for later success?
Yeah, I mean, I wouldn't be writing on Substack if it wasn't for it's called the unemployed value degen. I left Merrill Lynch. I went back to grad school and I studied finance, and I became a college professor. And I was told that, the university was like a family. No one had ever been fired except for one person had a mental breakdown and she didn't submit final grades. That was what it took to get fired. And the culture changed. They got a new president and they started not renewing a bunch of contracts. I don't know exactly the reason, but the new president was touted as having done incredible things for diversity, equity, and inclusion. And then a bunch of white guys' contracts didn't get renewed. So surprise, surprise, what happened to the family environment? So I became the unemployed value degen, and it's been fantastic because now I have 6,000, and any one of them can fire me, but they're not all going to fire me on the same day. So I don't have a boss. I'm completely my own force of nature, and then the opportunity is endless. I was reviewing my statistics the other day. Somebody pays to read what I write from Kazakhstan, right? It's just amazing how small the world has gotten. And I was originally from a town, it's called Pittsfield, Maine. It has a population of about 200 people. So I can find the house my grandfather used to live in on Beans Corner Road in Pittsfield, Maine. And you go from a town of 200 people to, I get monthly 100,000 people read my writings from all over the world. And it's such a humbling experience to see how small the world can be, how much reach we can have. It's absolutely fantastic. And I never would have discovered that if the university hadn't hired a diversity-focused president and stopped renewing contracts.
And I'm learning that as well, In earlier times, you would need to order financial magazines to stay up to date with the stocks market. But nowadays, it's like you find people, like you mentioned, you can outsource your stock research. I can outsource it to you, and it's like $7 a month, and then I get this super insight on certain topics I would have never discovered. So if you find out there like 2 or 3 Stevens, you don't need anything more than like it's so much time it saves and so much value you get for really understanding. And you see, even with the latest video you did about what you will buy this week, like you show a bit about technical analysis and price targets and all of that. So really great source of resource. So I'm really happy you got fired. Thank you for that.
Hey, wait a minute.
Thanks.
It sounds better. It sounds better when I say I'm happy I got fired. It doesn't sound as good when you say it.
I mean, you seem quite happy, so
yeah, I know. I'm just
win-win
just
for
teasing
everyone. Great. What is one of the best investments you've ever made?
Well, recently, Babcock and Wilcox has been the best. Something would have been the best, but I made a mistake with it. So I had done all of my research on Carvana, and I had bought a little bit when it was $7 a share. And the day that CarMax missed earnings, I bought 4,000 shares of Carvana at $3.92 a share. I think I really nailed the bottom. And I then, using options, which really hurt people, I sold covered calls on it at $5.50 a share. So I bought 4,000 shares of Carvana at $3.92 a share, and then I sold them all at $5.50 a share. And if you look up the stock price of Carvana today and multiply that by 4,000, I can beat myself up over that. That's going to end up being, I think, the biggest financial mistake of my entire career was selling my Carvana shares. But something very interesting is happening, which is a very similar market structure is happening with a company called Open Door. And so this time I have my shares of Open Door, and I'm not selling call options against them. The story of Carvana is you have these, in the United States, there's a lot of used car dealerships. The consumer does not have a good experience at a used car dealership. You have a knowledge problem that the used car dealer knows more about cars than you ever will. At the end of the process, you feel very abused. You wonder if you got a good price. You almost certainly believe you did not get a good price. And you have to sit there for hours while they fill out the paperwork to satisfy all these regulatory agencies. So it takes all day, and at the end of it, you feel bad. Carvana made that whole process happen online and made it a little bit fun, an unhappy consumer process, and turned it into a fun one. And they also targeted to break even. Right? They're aiming to break even on the cars and make all of their profits on the loan origination. Carvana makes all of their profitability, not making any money on selling you the used car, but just making the money on originating that loan mortgage. Open Door looks to be doing exactly the same thing. They're going to try to break even on houses, but make maybe $11,000 a house on originating the mortgage and the title. And buying a house is also a painful and unhappy process where, at the end of it, people do celebrate when they move into their first house. It is a big deal. But the process of going to the title agent's office and signing all the escrow documents and having the inspection takes over a month. It's not fun for the buyer. It's even less fun for the seller. Have the average broker fee is 6% in the United States. Globally, most countries is something like 1.8% that the real estate broker will make on commission for selling a house. In the United States, it's 6%, and the houses are very expensive. So this is a very inefficient market. It's ripe for disruption. I think there is a really good odds that Open Door brings to the digital age the real estate market in the United States. And if they disrupt that market, it could be a 20x, it could be a 50x, it could be a 100x from here. I think right now they're about $1 billion company. It could be $1 trillion company if they end up being the network on top of the housing market, that would be worth $1 trillion company. So my biggest mistake was selling my Carvana too soon. And I'm trying to not make that mistake again on Open Door. And it's very hotly contested. There's a lot of people with strong opinions for or against. It's definitely a battleground stock.
Interesting. You're the second guest on my podcast that mentions Carvana as their best investment. And something similar happened to me. I was playing around with selling calls, and then I had some of my Tesla stock got called away. And on top of that, I had the broker set up to first in, first out. So actually my cheapest positions got sold because it got called away. I was like, okay, now I made some money. But then I was like, my average price actually increased. Why did that happen? So I went down and sat down. It's like, oh, I didn't know about that, how they choose. So yeah, because my first entries were the cheaper ones, and then the stock went up. So learned a lot from that, and now I don't have a good position anymore, and then it's difficult. Yeah, when the ship has sailed, it has sailed.
Yeah. Yeah, that's the amount of harm people can do to themselves with options. It's a lot of tuition to pay for an advanced degree. So you just have to know going into the options world that there's going to be so many mistakes that it's kind of like paying tuition for a master's degree. So if you're prepared to make that a part of your life and to have that be an involved hobby for a long time, then be prepared to pay the tuition for it.
Yeah, the problem I see is that none of those gurus out there says it's difficult. They say it's so easy and you just have to follow their 5 points and then you will nail it, but it's not. So that's what makes me angry about the situation. It's like people telling you and selling you it's so easy, but it's like, no, just tell them it's an atomic bomb and, here's the atomic bomb, figure it out.
Yeah.
Steven, who should I invite next to this podcast? Or what type of topic should we cover that you say our listeners should really hear about?
Yeah, I have a good friend from Australia, and he's in investments. He's kind of carved out a niche for himself, focusing on these companies that are royalty companies. And so instead of, for example, owning a copper mine, a common thing is, maybe a copper mine, it also produces a little bit of gold as a byproduct. And while the mine is being built, the royalty company will invest in the mine and say, okay, we're going to give you this amount of money to build the mine. But what we want in return is you're going to give us all this byproduct gold you produce. So the copper mine is still operating based on copper, but the royalty company is receiving a stream of the gold that's produced as a byproduct. So this is a royalty company. They don't have any trucks. They don't have to buy any diesel. They don't have any workers. They have initially invested in the mine, and now they're receiving this byproduct ore out of it. So his name is Ben Damasi, and he has a channel called The Royalty King. And when we're done, I can send you a link to him. But I think he makes a fantastic guest if you are interested in that sort of niche investment, which it is a very interesting and unique kind of investment class. And because one thing that's interesting about mines is sometimes the deposit underground will last for 100 years, but it's very expensive to prove that. You have to spend all of this money drilling holes in core samples and having the geologists analyze it. So you might have a very good understanding that the ore deposit will last for 100 years, but the mine has only proven 10 years. And that's really where the royalty companies do very well, is to know that it's a 100-year deposit, and that even though on paper it looks like it's a 10-year mine life, it's really 100 years. And then it's a sort of thing that compounds very well over long periods of time. Anyway, so his name is Ben Damasi. He's got a channel called The Royalty King.
Amazing. I will reach out to him. Usually Austrians and Australians get along pretty well.
If they're not being confused by Americans that didn't study geography.
We have those T-shirts in Austria. They just sell no kangaroos in Austria, because it happens that people say, "Oh, Austria, Australia," and it's like, no kangaroos, just people skiing.
Yeah, it comes
Steven,
from
that
the
was a
Latin
big...
for east, though, right?
Does
Austria
it?
and
I don't know.
Australia, they both come from the Latin for east. In the Habsburg, you had the Habsburgs were in charge of Spain and Austrian Empire, and that was the eastern part of the Habsburg Empire. So it was called Austria because it was the eastern part of this Spanish-Austrian world at a time when everybody educated spoke Latin. I think Austria and Australia, they're both eastern parts of the territory.
Okay, true. Yeah, actually, because it's from Ostariki, which means the Eastern Reich, so which had later was used in a different sense. But yeah, sure, it comes from the Eastern part. You're right. Yeah. So Steven, thank you so much. That was an amazing deep dive. I have a feeling that was not our first and last one. I think if we meet in a few months again, there you have a lot of other new topics to talk about. So thank you so much for all your insights, and I see you on Substack.